Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Summer Webinar Series. This program is entitled 2021 Wealth Management Hot Topics, Actionable Insights on the Top Investment Themes of the Year. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. I also handle their life, long-term care, and disability insurance needs where applicable. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You could read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. And with that introduction, let's jump into the program. As you can see, I have a bold agenda for this webinar. We'll try to touch on a variety of timely topics. I hope to offer you actionable ideas for each section. So with that, let's jump right into it. Let's first touch on the obvious exuberance in the market. The other day, I received a call from a friend, a social worker at elementary school, who wanted to know the best way to purchase non-fungible tokens, or NFTs. NFTs are one of the trendiest current investment themes. They're essentially a unit of data on blockchain that represents a unique digital item such as digital art, audio, and video files. If you're still unclear exactly what this means, you're in the majority. What was a bit strange to receive a question about this in such an opaque area of the market from my friend, I wasn't overly surprised. Earlier this year, an 80-year-old client told me she made a mint on cryptocurrency in a side account she had with Robinhood. And my Uber driver told me he was considering an investment in a special purpose acquisition company, or a SPAC. These comments, along with the fact that every other person seems to be day trading to supplement their income, illustrate clear frothiness in the market. Speaking of day trading, meme stocks, which are companies that are bid up in price based on what a collection of amateur traders post on internet message boards, have also soared in value. Companies like AMC and GameStop, which have been duds for years, have skyrocketed over 2,000%, then plunged in value, but are still up big for the year. The important takeaway from all this speculation is understanding the need to filter out the noise in order to make prudent investment decisions when it seems like everyone else has gone crazy. Let me share a few ways to do this. The first consideration is, can you explain your investments to a child? The other day, I explained the difference between stocks and bonds to my 5-year-old daughter using an analogy to the lemonade stand she plans to open this summer. I told her that for her business to grow, she may need to borrow money or take on partners to infuse her lemonade stand with capital. She told me that she didn't want partners or to pay anybody money. While that may limit her growth potential, she now has a basic understanding of the distinctions between stocks and bonds. I had no trouble explaining these concepts to her in simple English because I understand them. I had a more difficult time trying to explain NFTs to an adult, mainly because I don't fully understand them, how they work, or the investment thesis behind them. One of the biggest mistakes people make when investing is rushing into opportunities that they don't understand. If their friends and colleagues are doing it, that doesn't necessarily mean you should be doing it. Take your time to understand how the investment functions and how you can expect to make money. Charlie Munger, Warren Buffett's partner at Berkshire Hathaway, is famous for having an investing approach with 3 boxes: in, out, and too hard. His too hard box is the largest. If other investors more frequently said, "I don't understand," and moved on to other opportunities, they would minimize their investment mistakes and be more inclined to stick with a sensible strategy during rough market cycles. The next point to consider is overconcentration. This is the opposite of diversification. When entering a new investment, it's important to take a small position to minimize large losses. When reviewing your holdings, if you notice that any one position accounts for more than 10% of your overall portfolio, then it's worth considering trimming that investment if possible. It is generally not a bad decision to lock in gains, even if the investment continues to appreciate in value. After all, the damage done by the position cratering and wiping out a meaningful portion of your net worth will be much worse. The next is, do you have a good discipline about when to sell? Most investors can point to the rationale of why they decide to buy a particular investment. However, few people have a framework of when they should sell. Allowing a position to grow unchecked can put too much of investors' capital at risk. That's why it's important to establish criteria for when to sell an investment. For example, selling strategies for hedge funds or mutual funds may be triggered by style drift, where the portfolio manager is investing outside his predetermined parameters. A stock may be worth selling after it hits a certain price or when the management team changes. And alternative assets may be worth trimming after a particular holding period, when they count for more than a set percentage of your portfolio, or the economic cycle shifts and the investment thesis is no longer relevant. The key is understanding your appropriate sell triggers and implementing them as needed. Another concept is, do you need the money you're investing anytime soon? One of the most important factors in managing capital is understanding the investor's time horizon for when they will need their money back. It sounds basic, but very often this concept could get lost in the euphoria of a bull market. When reviewing your investments, do so with the end in mind. If you need your money in the near term, then investing in venture capital or growth stocks should be avoided. On the other hand, if you have a multi-decade time horizon, you may wish to invest a portion of your portfolio in volatile small capitalization stocks that may appreciate more than the overall market. Furthermore, investing in illiquid private equity strategies may be prudent to take advantage of the illiquidity premium that compensates for not needing your money for many decades. An investor's liquidity requirements are essential to determine any investment strategy. And finally, do you understand what's happening with each of your investments, or do they operate within a black box? Some of the biggest mistakes people make with their money is giving it to someone who promises access to great opportunities and great returns without explanation of how this will be achieved. Be mindful that throughout history, the initial success of most fraud can typically point back to a lack of transparency. If any information is unclear or not forthcoming, take your money elsewhere. It's an easy way to sidestep any possible financial shenanigans. When it comes to establishing a proper process for managing wealth and avoiding speculation, the ultimate rule of thumb is to embrace boring over exciting. Contrary to what may be popular today, the level of exhilaration experienced with successful investing should more closely resemble watching paint dry rather than a day at the racetrack. The next topic, which is always timely and especially important today, is the topic of cognitive biases. The field explores the effects of psychological, cognitive, emotional, cultural, and social factors on an individual's decisions and how it influences one's judgment. The first bias that is prevalent this year and that directly relates to what we just spoke about is outcome bias. We typically judge a decision based on the results. If we have a successful outcome, then we must have made a good decision. However, if we have an unsuccessful outcome, it must have been a bad decision. In reality, we can experience a good outcome based on a poor decision, or we can experience a bad outcome even though we made a good decision. Humans tend to underestimate how much luck plays into our lives. As an example, many novice investors today have concluded that the quality of the outcome, such as high returns, confirms that they have a knack for picking winning investments. In many cases, this couldn't be further from the truth. Over the short term, one can have great returns simply by getting lucky. Conversely, one can have short-term returns that are bad with a good process and will ultimately allow them to achieve their financial goals. Going through a slump with mediocre performance does not necessarily mean that your strategy is ineffective. The next is sunk cost fallacy. While the public markets overwhelmingly had attractive returns, there are still pockets of poor performance for specific companies as well as private investment opportunities. The sunk cost fallacy is when we illogically fixate on the price we paid for an investment, especially when that investment has performed poorly. As a result, we may irrationally hang on to a losing position with the hope that it will eventually return to the price we paid for it. I have some clients who own GE, Boeing, a company formerly known as CenturyLink, and other formerly high dividend paying companies. These clients hold on to these securities with the hopes that they will one day restore their hefty dividend and rebound in price. Unfortunately, while they have been hoping for a favorable return of events, they also missed the run up in the market. As any honest professional will tell you, that hope is not a strategy. It's far better to plan ahead before one takes an investment by deciding how much money they're willing to commit to a particular opportunity in order to put guardrails on the investment. If you do lose money, it will be much more manageable because no further capital will be committed. The final bias I'll discuss today, and one that I have mentioned in previous webinars, is confirmation bias. This bias is the fact that people are naturally drawn to information or ideas that validate their own existing beliefs and opinions while ignoring any other information to the contrary. I've seen this bias on full display over the past couple of years when it comes to folks who own Bitcoin. I like to call them Bitcoin evangelists. Some of these people have liquidated most of their other investments and put all their money into Bitcoin, expecting the debasing of fiat currency and a movement towards the entire world embracing crypto. That's an interesting perspective, but it's worth hearing the arguments against Bitcoin and taking them seriously as well. For example, what happens if the government decides that the use of crypto is primarily used for extortion by hackers, criminals, and other types of thugs and decides to ban its use? This may be a small possibility, but a reasonable one that should be considered. The methods to overcome these cognitive biases are by introducing the tried and true strategies that take emotion out of the investment process. This includes embracing automation such as dollar cost averaging, systematic rebalancing, and diversification, to name just a few. Another question I've received this year is, I just came into a large sum of money. Is now a good time to invest? Determining the optimal approach for investing a large pool of cash is always challenging. The fact that markets are trading near all-time highs can further exacerbate this predicament. Let's discuss a framework to help investors implement the prudent strategy if they're looking to invest a windfall. The first point to consider, first point I should address, is market timing. When it comes to market timing, the most important thing to keep in mind is not to try it. You will not be successful in the long term with this approach. Now that we got that out of the way, let's explore some practical strategies. The next point, and one that I've always come back to, is diversification. The concept has become a cliche in the investment business and gets repeated very frequently, but I keep repeating it because it actually works. While the US market has been setting record highs, many other markets have not had such a good run. For example, European and emerging market equities have had a relatively underwhelming returns over the past decade relative to the US. These markets may experience a reversion to the mean, making their potential returns much more attractive than they have been over the past 10 years. Maintaining a diversified strategy when deploying capital can minimize volatility by balancing assets that were bought high with other sectors that were purchased at cheaper prices. The next point is whether you have a long time horizon. The market's long-term trend is positive. Therefore, the best course of action for an investor who doesn't need the assets for a long period of time is to invest a lump sum all at once. Buying at lower average prices now will likely outperform someone who's slowly adding money over time. If you have a multi-decade time horizon and your specific risk tolerance doesn't indicate otherwise, then consider putting all the money to work right away and don't think about it. Chances are it'll be the right decision. The next consideration is whether you're approaching retirement. Folks who are retired or who will be retiring shortly need to be the most careful with their investment strategy. Getting caught in a major market downturn right before you stop working can be devastating. This is called sequence of returns risk, which is the risk of experiencing a string of unfavorable returns as you begin to draw down on your portfolio. It is a very difficult scenario from which to recover. One way to manage for sequence of returns risk is to set up a bond tent. The concept of a bond tent is to keep a few years worth of expense money in very short-term, high-quality bonds or cash. The remaining assets can be invested, perhaps more aggressively, according to their various other goals. Should the market have several years of subpar returns, the investor won't have to liquidate their more volatile holdings at a steep loss. Rather, they'll be able to use their cash cushion or high-quality bonds to meet their expenses as they wait for the market to recover. And finally, it's important to consider this pool of assets as a percentage of net worth. Objectively, the amount of new money to be invested may be large, but it's important to consider its size relative to your total savings. If the figure is less than 25% of your investable assets, then it may make sense to just invest it all at once in a similar allocation to the current portfolio. It is a relatively small sum of money, and stressing over how to invest it won't necessarily change your current or future lifestyle. For the scenario where the lump sum represents 25% or more of your total savings, there are a few more factors to contemplate. First, considering the source of the new assets may help provide guidance on how to deploy them. If it's a pension or 401k, the money was probably invested in stocks and bonds prior to being liquidated to move to an IRA or another 401k plan. So the money should immediately be reinvested into the appropriate allocation based on your age, time frame, or risk tolerance. There's no benefit in delaying. If it's inheritance, the specific needs of the investor will play an important role in determining the next steps. If the investor does not need this cash in the immediate future, a strategy that includes a combination of investing a large portion of the money immediately and dollar cost averaging over time may make sense, but will need to be customized to the investor's current situation. If the windfall is from the sale of a business, a multi-pronged approach where different portfolios are set up depending on various goals may make the most sense. If the sale is right before the client's retirement, then a similar philosophy as the person who's approaching retirement should apply. However, if the investor is young and planning to start future businesses, they may require a certain level of liquidity. In a legacy planning scenario, putting a large sum of the assets to work right away may be prudent given a potentially lengthy time horizon. It's important to remember that since this money was tied to a business, there was already risk associated with this capital. The fact that the proceeds can now be diversified among a variety of different asset classes is actually a wonderful opportunity to de-risk one's assets. The bottom line here is that coming into a windfall is a good problem to have. The most important step is to touch base with your tax, legal, and financial advisors to get advice on your new financial situation. The question I receive most often from soon-to-be retirees is, where should I invest my money to generate sufficient income in retirement? With interest rates at historic lows, folks need to rethink the question of high income and instead focus on increasing cash flow. The distinction between income and cash flow is important. Generating income in retirement is focused on finding investments that pay a high yield, which means taking on more risk. Focusing instead on cash flow allows investors to take a broader perspective, assessing various aspects of their finances to determine how to creatively produce the money required for expenses without taking more risk. Let's discuss several ways for investors to increase their cash flows in retirement. One of my favorite strategies is a total return approach. Interest and dividend payments are not the only way to generate cash flow. Investors can also sell their appreciated stocks to help meet their income needs. Supplementing dividend and income payment with long-term capital gains is known as a total return. This is especially timely today with the markets hitting all-time highs. Everyone should also consider Social Security strategies, which I'll speak more about in a few slides. There are also alternative financial resources. One example is reverse mortgage, which is available to homeowners age 62 or older. The homeowner can borrow against the equity they have in their home and receive funds as a lump sum, fixed monthly payment, or a line of credit. The homeowner does not make any loan payments. Rather, the entire loan balance becomes due when the homeowner dies, moves away permanently, or sells the home. This can be a useful approach for those with a home, but few other financial assets. However, there are a lot of considerations when it comes to reverse mortgages, and it's imperative that investors understand that it is not a good option for everyone. Another alternative income source is cash value in one's life insurance policy. If you no longer have a need for life insurance, it's worth evaluating the level of cash in the policy against the fees and process to take it out. An added benefit of both of these approaches is that they can help mitigate sequence of returns risk in retirement, which I spoke about earlier. If one's portfolio is falling in value while the investor is withdrawing funds, the ability to use money from a reverse mortgage or cash value can minimize this risk by providing a financial cushion, since they won't need to withdraw as much money from their portfolio during a market downturn. You can also utilize an annuity to offset risk. Offsetting risk to an insurance company provides guarantees to the client, such as lifetime income. Annuities should be viewed as a long-term financial product and are typically purchased 5 to 10 years before retirement. One popular income-generating annuity amongst retirees is a single premium immediate annuity, or SPIA. For a SPIA, You pay an insurance company a lump sum premium upfront in exchange for the guarantee of periodic payments to you for life and possibly for your spouse's life. Knowing that certain basic expenses will be covered through guaranteed income can offer retirees a great deal of comfort. An added benefit is expanding the investor's flexibility to take on more risk in other parts of their portfolio to potentially achieve a higher rate of return. This can be beneficial for leaving a legacy for one's heirs. Annuities have a bad reputation, but an appropriate annuity can be incredibly beneficial for the right set of circumstances. Finally, there's what I like to call geographic arbitrage. If you spent most of your career in an expensive city, geographic arbitrage may be a lifestyle change worth considering. The concept is to take advantage of one's higher career earnings associated with living in cities like New York or San Francisco by retiring to a location where the cost of living is cheaper. For those who are open to retiring abroad, there may be a benefit from capitalizing on the strength of the US dollar relative to the local currency. The decision to relocate to cheaper pastures can help your nest egg last for longer. The next topic is preparing your portfolio for inflation. Since 2008, inflation has stayed at 3% or less annually and has not been a point of apprehension for most investors. However, over the past 12 months, the consumer price index jumped by over 5%. While this increase was alarming to many, it is especially concerning to those who are approaching retirement and need their savings to last the remainder of their life. When people hear about inflation, they generally assume the worst case scenario, which would be something along the lines of what happened in Zimbabwe in November 2008, where the peak inflation was estimated at 89.7 sextillion% year on year. While we are very far away from anything of this nature, it still makes sense to plan ahead. Let's look at some proactive strategies to take. The first thing you consider, and one thing I have alluded to, is to delay claiming Social Security. Today, full retirement age for retiree to get their full benefit is 66. One could claim Social Security as early as age 62, but anything before full retirement age comes with a reduction in benefits up to 30%. Conversely, Social Security will add an additional 8% delayed retirement credit to your monthly payout for each year up until age 70 if you hold off on claiming the benefits. That's a guaranteed annual return of 8% for deferral after your full retirement age. There's also the added benefit of a cost of living adjustment, which has averaged about 1.5% a year over the past 10 years, and will likely be much higher this year due to the CPI number. The COLA increases may not be enough to keep up with inflation. Nevertheless, there are not many forms of guaranteed income in retirement planning that also adjust for the increasing cost of living. The next consideration is to purchase items that you will need in retirement today. This may not be possible for everything needed in retirement, but it is a practical strategy for some projects or goods. For example, if you were planning to do construction on your home when you retire to accommodate possible lifestyle changes, like building a master suite on the first floor with a handicapped accessible bathroom, then getting a jump start today may be sensible. Waiting several years until you actually retire may result in a significantly increased cost of renovation due to high inflation. We saw this in action this year with the price of lumber soaring to a multiple of what it was trading at just a year or two prior. One may be able to absorb these price increases while working, but may not be able to do so once they're in retirement. Next, position your portfolio to withstand inflation pressures. If you don't want to outlive your funds, it's imperative to structure your portfolio to outpace inflation. Some considerations are your overall allocation. The returns on stocks tend to outperform the pace of inflation over an extended period of time. For example, from 1972 through 2021, inflation has averaged about 3.8% per year. The total US stock market has grown at over 10.8% annualized over the same time frame. Investors with a multi-decade retirement should consider allocating a sufficient portion of their portfolio to stocks, even in retirement, to ensure that they're able to maintain their buying power after inflation. Real estate. Investing in real estate, either in physical property or publicly traded REITs, tends to serve as a good protection against inflation. Owners of real estate receive income payments through rents and leases and are often higher yielding than bonds. Owners also have the potential to increase rents over time, and the properties themselves may also appreciate in value. These characteristics make a natural hedge against inflation. Next is Treasury inflation protected securities, or TIPS. TIPS increase in value in order to keep up with inflation. The value of these bonds are linked to the consumer price index, and their principal amount is reset according to the changes in this index. Therefore, if CPI continues to rise at an above average pace, so will your investment in TIPS. There's also investing internationally. Inflation does not necessarily impact countries around the world in the same way or at the same times. As a recent example, Venezuela's hyperinflation hit 10 million% from 2018 to 2019. In the US, inflation over the same time period was only 2.3%. While this is obviously an extreme example with many factors at play, it does illustrate that different countries experience inflationary environments at different times. Allocating a portion of your portfolio to investments outside of your home country is prudent and worth considering. Another strategy is to work longer. This strategy is undoubtedly the least popular, but it's also the most effective. For those folks who are still able to work, there is nothing that will serve as a better hedge against inflation. Working longer in your current job or consulting part-time allows folks to delay spending down their nest egg. Instead, they can use their income from employment to continue to maintain their lifestyle. This strategy requires one's savings to last for a shorter period of time and allows one's assets to grow for longer. For example, if you retire at age 70 instead of 65, that's 5 fewer years that your assets will need to last. Furthermore, if you had a $2 million portfolio at age 65, growing at a modest rate of 4% a year, it will result in an additional $430,000 at age 70. That's a nice additional chunk of savings to absorb the effects of rising inflation. Not everyone's able to continue working for health, family, or other reasons. But for those who can, it may be the closest thing to a silver bullet to address all their inflation concerns. Let's now just focus on our final topic, which is preparing for higher taxes. While it's not guaranteed that taxes are going up for wealthy Americans, it does look likely. To help fund the American Families Plan, the Biden administration has proposed increasing capital gains taxes to 43.4%, including the net investment income tax surtax of 3.8%, from the current rate of 23.8% for those who are making $1 million a year. Additionally, the current estate, gift, and generation skipping tax transfer tax exemption of $11.7 million is scheduled to drop by half to $5 million at the end of 2025. While politicians haggle over the details of the final tax legislation, it behooves all high net worth investors to evaluate proactive steps to plan for a world with higher taxes. This topic can fill up textbooks worth of information and hours worth of webinars. Instead of doing a deep dive, which many folks have already done, I will just share 4 practical strategies to consider today. The first is timing of capital gains recognition. Someone with large gains in their portfolio may consider recognizing gains now in order to potentially lock in the lower capital gains rate of 23.8%. It's important to note that if the Biden tax proposal is enacted in its current form, investors will be hit with a higher tax rate retroactively as of April 2021. But the solution for many will be to time gains over several years to stay below the $1 million income threshold where the higher capital gains rates apply. A better strategy may be to comb through your accounts for investments that have been losers. Now may be a good opportunity to recognize the losses, utilizing them to help offset large capital gains and avoid the higher tax rate. The next is donor advised funds, or a DAF. I'm a huge donor advised fund fan and have used one myself in addition to recommending them to clients. A DAF is a fund that is set up to manage charitable assets. Investors can contribute to highly appreciated securities, real estate, and even some cryptocurrencies. When the contribution is made, it's not subject to capital gains taxes, and the donor gets a tax deduction at the current fair market value. Under current law, you may qualify for a charitable contribution deduction to offset the income at the maximum income tax rates. Another strategy for investors who are charitably inclined is to create a charitable remainder trust, or CRT. This irrevocable trust reduces an individual's taxable income by first dispersing income to the beneficiaries of the trust for a specified time frame, and then donating the remainder of the trust to charity. An investor with highly appreciated technology stocks that now account for the lion's share of their portfolio may consider donating the securities to CRT instead of rebalancing and paying taxes on the gains. In doing so, they can sidestep capital gains taxes, receive a partial tax deduction, provide a beneficiary with a stream of income, and leave the remaining assets to charity. Finally, for folks who are ultra high net worth individuals, consider a spousal lifetime access trust. Bernie Sanders has proposed reducing the estate tax exemption to $3.5 million from $11.7 million per person and raising the estate tax rate to 65% from 40%. This means a family with a nest egg larger than $7 million owe a substantial estate tax upon death. One estate planning strategy is to take advantage of the current high exemption amount and gift up to $11.7 million per spouse to an irrevocable trust. Those assets may grow outside of one's estate, thereby escaping estate taxes. One of the drawbacks of using some traditional irrevocable trusts is the lack of access. If you set up a trust for your kids, you cannot benefit from it. The assets may be outside your estate, but most people cannot afford to give millions to a trust if they can't access the money if needed. A popular technique called a slat allows married couples to create an irrevocable trust for the benefit of one another. With this approach, they'll each be a beneficiary of the other's trust. Executed today, such a strategy could allow one couple to protect up to $23.4 million of assets from the proposed higher estate taxes, plus savings on the potential growth that takes place after the gift. Naturally, consulting a competent attorney and other financial experts is essential to properly executing all the strategies I have mentioned. And that concludes today's presentation. I hope everybody was able to take away a nugget or two to implement into their own life or practice. If you have any follow-up questions, please feel free to reach out to me directly. I'm always happy to find ways to work together. Two more quick items before I let you go. The first is this is my final webinar for my summer series. My full webinar series will begin on September 30th, and I'll send out invitation to these programs in the coming weeks. I hope you can attend. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.